Passive Pockets is presented by Equity Trust. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Paul Shannon. Today I'm joined by Ryan Duff, a lender turned operator who brings a debt-first lens to sourcing, underwriting, and managing commercial real estate. Ryan has financed deals across cycles, invests as an LP in more than 4,000 multifamily units, and now runs Seaport, a firm focused on disciplined capital structure and risk management. We'll look at how lenders really size loans, the metrics that matter, how passive investors can protect themselves, what went wrong in the last few years, and how Ryan is building differently at Seaport. Let's jump in. Ryan, welcome to the show.
Thanks, Paul. Appreciate you having me.
It's nice to have you here. Before we get into the meat and bones of the conversation, why don't you tell us a little bit about your background in debt financing and how you got started in real estate?
Sure. So I've been in the business since 2010. Right out of school, I took a job with my former employer in the debt financing structured space, focusing predominantly on the analytical work, financial modeling, running Excels, hammering through rent rolls and P&L statements on behalf of a pretty deep group of sales originators that were spread across the country representing their own books of business that they had created over, their careers. And I sat in that seat for a couple years, got a ton of reps, really understood the business, what debt vehicles made sense for what deals. And in about 2012, 2013, within Arbor, my former employer, I jumped over to the sales origination side and I started building a book. I felt like I had, a pretty deep understanding of what it took to be successful, to originate loans, to drive volume and add value on behalf of my clients. And I started building a book of business over the next, call it 10 or 12 years, ended up doing probably about $4.5 billion worth of debt placement, several hundred transactions ranging from the mom and pop operator all the way up to the institutional developer. Along the way, I started investing selectively with the right guys, guys who I felt were doing the right thing, developed a rapport and a relationship with a select group that kept coming back, obviously from a financing standpoint, but really better understood their ops, their operations, their management, the markets that they were investing in. And I got pretty comfortable handpicking certain deals that I wanted to kind of dip my toes in as an LP on. And fast forward to about a year ago, I left my employer. A couple reasons being, I found myself more and more on asset management calls and workout events, right? Obviously, when rates started to rip, from call it 2021 to 23, catching everybody off guard, we did a lot of structured bridge lending and got over our skis a little bit in certain situations. And instead of originating and doing my day-to-day job and being productive, I just found myself wedged between my client book and the house, trying to represent both sides equitably and make deals. And that wasn't a good use of my time. So I decided to leave. Before I left, about 6 months prior, I started building out my business plan, which is now Seaport Equity. It's evolved since I left, but I really took a lot of deep understanding of the underwriting credit side, investing as an LP, and I translated that into what is now 3 funds later, making 8 investments over the last 12 months, our first year since inception, totaling about 1,700 doors. And I raise equity from LPs across the country. And we invest with that select group of GPs that I've brought with me. I've since expanded that bench as well. And that's where we are.
Well, there's a lot to unpack there, and I'm looking forward to it. I definitely want to get into a conversation around a little bit about your old employer, talk about your experience as an LP, as a GP. You've got a unique background with a lot of different kind of multifaceted angles into the commercial real estate space. But first, I want to talk about just what the lens is that you look through as a lender, and how does that differ from the borrower, i.e. the GP? Sitting on that side of the table is much, much different. So how has that sort of helped you and given you some advantages in your background coming in from a lender side?
It's been invaluable. My ability to, first and foremost, source the right deals at this point. As I've mentioned, there's probably a half a dozen or so GPs that I'm still very close with that I've invested with pre and post departure. And as I mentioned, I've expanded that bench with new operators that are local to their markets that I feel are doing the right thing and investing in deals that are similar in profile to where I want to be. But I think just the ability to take a look at, the proverbial back of the napkin or envelope, high-level details on a particular situation and say whether I'm interested or not in a matter of minutes was born from the experience that I had on the underwriting debt side. As I mentioned, my former employer, we were a big volume shop. We had a lot of reps. We screened and sized a hell of a lot more business than we actually closed. And so, throughout my time there, it really gave me a good understanding how to look at a property performance, both historicals and present, and really gear up and better understand how it can perform in the future, which obviously is investing 101, right? So I think, the sheer ability to, identify low-hanging fruit and opportunities. Clearly, there are a lot of them in the current environment, just given the dislocation that occurred over the last several years, both from a capital market standpoint. But I also think there's been a lot of operational deficiencies in the marketplace where, the whole world of syndication really formed, 6-7 years ago. And, you had a couple groups that had a couple dollars to put together that didn't really have multifamily operation experience. And they went and acquired a property across the country because the cap rates looked good and, they could get 80-85% leverage on their debt, and they weren't able to execute. And so, I think the access point that I had on the lending side really has positioned us to be kind of a pioneer in the space that we're in right now, right? You're seeing trade volumes that have dropped off 40-50%, year over year. A lot of liquidity sitting on the sidelines, people trying to find deal flow, complaining that they can't. But the experience and the track record that I kind of bring to the table in my new platform on behalf of my LPs has really allowed us to create a consistent pipeline of activity and action where we can be hyper selective and dialed in on the deals that we are looking at, which is a week by week basis, right? I mean, we're probably taking a look at, 5 or 6 deals a week, I would say. We're trying to close probably between 8 and 10 transactions a year. But the ability to really take the underwriting lens and approach that we have on a volume basis and sift through the noise and understand who the operation is, the market, the track record of the property performance in a particular location and the condition it's in versus where it could be at or perform to in the future is really a value add, that we bring to the marketplace at this time.
Makes sense. Let's dive into that a little bit more. You talk about underwriting, and this is a community of LPs. So when we see deals, the first things that we look at oftentimes are what's flashed across an offering memorandum or a pitch deck. And that's IRR, cash on cash, equity multiple. These are the flashy metrics that get a lot of attention. But what's really under those metrics, and those are outputs, right? So what inputs were used is what we try to focus on more when we educate our LPs. So as a lender, are there different metrics that you're really keen on and you focus in on? I'm thinking like debt service coverage ratio, break-even occupancy, debt yield, current occupancy trends in the marketplace. How do you look at underwriting maybe a little bit different than a typical GP and an LP?
Yeah, I think the past 3 to 6 trailing months are really key. And I say that because there is a lot of misrepresentation in those data points that you mentioned. They can be misleading. You can take a look at a rent roll, and yes, it might be 93% occupied today, but they might have, 10 or 15% of their unit mix that's turning over in the next 3 to 6 months, which you would inherit as a buyer day one. A lot of what's going on right now, you're seeing rents plateau in certain markets, right? So really there's been a delta between market rent or gross rent and what these properties are achieving. And so oftentimes we're seeing loss-to-lease numbers bake up. And what I really try to take a look at is economic occupancy of a property, okay? And there's a couple variables that go into that. Obviously, one is your physical vacancy, which, take your 100% fully baked, fully occupied property and however many heads are in the beds, and that delta drives your physical vacancy. Concessions that are being offered right now, right, is the second variable in that equation. There's a lot of competition in the market, especially with new builds and new deliveries where owner-operators are having to offer free rent just to fill their property. And then the last part of that economic loss is loss to lease, as I mentioned, right? And that has to do with, demographics, tenant bases, operators' inability to optimize their tenants and drive that top line to get that premium market rent. So at Seaport, what we do is, we really look under the hood at those 3 variables. And what that can tell you is really baked in the last 3 to 6 months of the operation. So we take a look at, how the property's been performing throughout that time frame. That gives you the ability to either extend on an offering or allocate a bit more than you typically would because there's further upside with, the right operator and the right GP coming in to execute that management and that operation. And so I'd say the economic vacancy is a key component that a lot of LPs passive don't really look at. because they're not as familiar with the underwriting process or analyzing the trailing performance of a property that we are. And so that really gives us a leg up, and our ability to identify opportunities and sift through the noise that may just be, kind of clouded by a sexy or attractive IRR or a multiple. And don't get me wrong, those are important characteristics of a deal, but in my opinion, they tell 30-40% of the story.
They are important metrics, but what I find most fascinating about your answer to that question is that we didn't talk about expenses or net operating income at all, or debt service coverage ratio or anything else. You were talking about basically the delta between gross potential rent and effective gross income and everything that falls in between, and how wide is that delta and how much wider could it get based on concessions and leases turning over, et cetera, et cetera. So I think that's a really different way to look at it, and one that is very relevant in today's market in particular.
Yeah, I agree. I mean, listen, expenses in most cases are fixed. There are a couple variables in the market today that are a bit unknown because of replacement costs going up. Obviously, insurable values going up across the country. We're seeing insurance costs go through the roof in certain markets, most markets, but some are just getting a little bit crazy. But other than that, the property operates the way it operates within its comp set in the market, and so, those are the easy understanding line items whereby we can look at a property and identify, for an R&M or a payroll or an administrative perspective, what the cost per door should be based on its peer set in the market. Management fee is generally fixed. Reserves are generally fixed. Taxes are going to be, fixed at the market, depending on the millage rate or the reassessment exposure that you may or may not have. And so really the deals are made on the upper several lines of the income. You see a lot of operators go in and, even to this day, they're buying super tight cap rates, and part of their business plan is to add ancillary income streams or pet fees or implement a RUBS program. That only goes so far, right? And so if your business plan is to accelerate or promote those variables, your ability to drive that bottom line is diminished. And so it's really, there's an overemphasis on the economic loss of the property. And that's where most of the reposition, in my opinion, comes from.
So Ryan, you're also a limited partner in roughly 4,000 multifamily units. Is that correct?
Just about. Yep.
Where are those assets located, just to give our audience a little bit of a...
Sure. So I'm based in Boston, Mass. Obviously we invest with GPs across the country. I'd say historically speaking, we were East Coast, Eastern Seaboard. I'd say Mid-Atlantic South over West to Arkansas. We have, ancillary footprint in Portland, Maine, which is the only Northeast market we're currently in. There's one deal in Connecticut, but I'd say by and large, Carolinas, Tennessee, Georgia, Florida, and we've recently started to migrate west. And so we're closing a deal in Indianapolis, specifically Greenwood, tomorrow. We're closing a deal in Houston, Texas, which will be our first investment in Texas on Friday. We're really going where good GPs and good operators are. There's good deals across the country. You just have to have access and know where to find them, right? So we'd like to say that, we go against the herd in a sense, but that's not entirely true, right? I mean, there's good deals everywhere. There's dislocation and pain in markets across the country. And, we're really trying to follow good demographics, good migration patterns and trends. Obviously, tax-friendly states for both the tenant and the landlord, is a positive. But we're market agnostic at this point.
Got it. Greenwood's right up the street from me. I'm in Indianapolis. I'm only about 45 minutes from there. So I'm on the northeast side of town.
Great. Yeah, I'll do a plug here. Spencer Gray and Gray Capital is our lead GP on that deal. I flew out there last week and met with those guys. They're doing great things out there.
Yeah, you're in good company. So as a lender, you're sitting in the lowest position in the capital stack. You have considerably less risk. And as an LP, your common equity, you're sitting in the exact opposite seat. You're in the highest position in the capital stack and you're taking on the most risk. Tell me about your experience as a passive investor, both as from the angle of a performance perspective, but also just what has it afforded you as far as perspective internally as you look at these deals, and how has it made you kind of grow into the space? Because before, if you're just a lender, you're looking at it from one angle. Now you're seeing it from another. Tell me about that experience.
There's more heartburn. I think obviously now I'm managing people's money, and they're expecting me to be a good steward of their capital and offer an alternative that they don't otherwise have access to. That's why they're using me as kind of that segue into the opportunity. But you're right. On the lending side, you're in the fee business. And there's no risk, there's no recourse. Obviously, in the agency world, Fannie, Freddie, and HUD, they're all non-recourse loans. So your risk and exposure is minimized as a result. It introduces a different element of risk assessment. And what I mean by that, and I think where you're going with the question is, where do you gain comfort and how has that changed jumping from a, call it a non-recourse or non-risk type seat into, representing an outcome? And I think my answer to that is investing with the right people, right? We really do a good job of, when we do invest with a new GP in a new opportunity in a new market, these individuals have to be local. They have to have cycled through deals in their marketplace. Their reputations need to be rock solid. And I think as a passive investor throughout my career, there have been situations that didn't turn out too well, right? And I can look back, and there are very few. I can probably name two only, but I can look at those situations and really say that I didn't do all my homework and I didn't do all my due diligence and really understand the operator and the operation and the potential varying avenues of outcome that can come from a situation. Not everything goes right all the time, right? And so, unfortunately, over the last several years, there's been external macroeconomic events that have impacted the situation and the outcome for many. I can say that some of those deals have gone bad, but a lot of those deals have turned out okay because they had the right operator and GP in place that are doing the right thing. They're not calling capital. To the extent that there's a deficiency or a shortfall at the property level, they'll fund it themselves. They had good fixed rate debt instruments in place. They didn't over leverage themselves. And so I think all of that comes back to just the experience and the track record of the GP and the operator. They're not located in certain markets. They don't necessarily own 10,000 units, but generally folks that are local to their marketplace have a really dialed in approach and access point into their environment whereby they can maneuver or circumvent a problem or solve one much easier than a non-local operator could that might be buying a property across the country from where they reside. So not to say that I don't appreciate the world of third-party management, but I would say 95% of the GPs that we invest with are vertically integrated and self-perform on site. And I think that is a huge bonus and value add for LPs to consider, when they are vetting the operator.
Yeah, I want to unpack that a little bit further, but to build on the last question, I'm just curious, of all the deals that you looked at sitting in the seat as a lender that you underwrote and eventually funded, what percentage of those deals do you think you would have invested in common equity in the same deals?
Not a handful. I would say inside 5%.
I think a lot of LPs think that if a bank is loaning this borrower, this GP, this group capital, they've done their due diligence, and they have to a certain degree, but they always forget that that bank is sitting in first position and they are lowest in the capital stack and they have low loan to value potentially. So if all these things go wrong in the business plan, they still have the collateral and they can liquidate it, or they can bring in another GP and replace that GP team through covenants that are in the loan documents. So the risk is significantly reduced, whereas common equity, not much has to go wrong for you to start to lose principal, really. So that's a perspective that I think is really unique and interesting that you probably have, much more so than I do. But investing in debt locally, I look at those types of things. I've seen deals that I've passed on that then come around back to me, and it's like, hey, we need private money for this deal. And it's like, oh my goodness, I can't believe this. But yeah, this actually makes sense from that angle, not from the LP angle. But
yeah, they do. I mean, listen, it's a business, right? And it's fee driven. And, lenders and seller servicers and banks are compensated to put dollars out the door and create liquidity for various asset classes, right? I mean, we sit specifically in the multifamily space. My former employer, we were, seller servicers of agency debt, Fannie, Freddie, and HUD. And that's a government backed instrument. Right. And so the FHFA has employed middlemen or brokers, lenders, to deliver the marketplace their capital. And to your point, yes, there are checks and balances. Yes, there are guardrails and goalposts to get comfortable and underwrite. But at the end of the day, to your point, they're non-recourse. Right. The borrower can walk away and throw the keys to the bank or the lender and have, no hooks or teeth or covenants whereby they're on the hook for a percentage, all or a percentage of that loan. So it's certainly a different seat to be in, but it's a valuable one. I mean, the marketplace wouldn't exist without them. And they're the largest liquidity provider of debt in the multifamily business across the country. So, and that's not going to change.
Well, let's talk a little bit about this. I want to put you on the hot seat for a minute here about your prior employer, the seller servicer who you mentioned earlier in the conversation. Seller servicer just basically means that they're a broker of debt, and currently they're under investigation for falsifying loan information and basically pushing loans through Fannie, Freddie, HUD by inflating net operating income to meet a certain debt service coverage ratio. And that's my understanding of it. Maybe you can elaborate on that, and there's other things that could be left out of my narrative. But what exactly was going on, and why did it happen?
Froth. We were at a moment where, the environment was a hockey stick type trajectory. And I will correct you, if I may, in that wasn't necessarily, the work on behalf of the lender and what they did, but the mortgage brokers that they were working with. And I'll say a few names just because, quite frankly, I don't really care. Meridian Capital, Eastern Union, there's no secrets of these, two shops. They've all been written up several times in the Real Deal, and, had several employees that were, questioned. And, I don't want to use the term indicted, but, there were moments of falsification, misrepresentation. And so as a lender, you're only as good as the quality of the diligence you're provided with, right? And so when that comes from a third party source, not the owner or the operator of the property or even the management company, when the deliverables come in through an intermediary and then to the lender, there's a lot of room for error. And so as a result of that process, that middleman, that intermediary, there was a lot of situations and a lot of deals where operating data, rent rolls, P&Ls, historical trends, pro forma budgets going forward were misrepresented based on the actual operations of these assets. And so from a lending standpoint, you require these sources to sign affidavits of clarification and certainty that what they provide you is fair and true and accurate. And so you're really putting the onus on the source of that diligence or that document. And so unfortunately, and my former employer was not alone, there were several peers and comps in the market that worked with these individual shops that had loans that went bad as a result of this, because the job of a lender is to underwrite the property, underwrite the diligence they're given, know the sponsor, get their market intel with the PCAs and the appraisals, and get true market valuation. And so those three criteria buckets, if they check off, there's your deal. And so unfortunately, unbeknownst in most cases to the lender, and I'm not singling out my former employer or others, but there were several, unbeknownst to them, they were being delivered falsified information. And so as a result of that, you inevitably get looped into a sniff test or, have to answer questions. And obviously, when your name is tied to a loan or a pool of loans that goes bad, you're the first person that gets called out for it. However, there's a trickle-down effect, and that's exactly what happened. And I will say, since that moment in our industry, there's been a lot of cleanup. There's been a lot of credit enhancement and tightening that's gone on, which has made it more challenging for GPs to get loans, but I think for good reason. And, a lot more onus, a couple characteristics of an underwrite I'll go to from a lending standpoint that have improved. Equity in the deal from a GP standpoint. We used to be able to get deals done where sponsors had no skin in the game. Now they're required to have 8, 10+% equity. We now have checks, right? Lenders are no longer able to receive documents from brokers or from intermediaries. If they do, those deals become full pre-review, which means the agency, Fannie and Freddie, takes the whole package in, the loan package, even if there's no waivers or guide, bends that the lender is asking for. They'll take the whole package in and vet the parties and the people involved, and make sure that they're not repeating history in a sense. And so there's been a lot of good that's come out of that moment. I'd like to say they're on the other side of it. Certainly folks have been reprimanded and called out for it, but by no means was my former employer involved in the nefarious handling of certain documents and diligence and deal flow. It was a product of the source of the diligence that they had received, who had, basically verified the credibility and the source of it. So that was, I think, a moment of froth and greed in the marketplace that I think's been flushed out a little bit. And I think some of those intermediary or mortgage brokers no longer exist, or they do, but they've had their wrists slapped and they're no longer able to do certain things that they once were.
Is there any accountability that should be placed on the GPs for this happening, or was it all the intermediaries?
I wouldn't say all. That's not fair. I will say that there were a few actors that grabbed a significant amount of market share in a short period of time. And so when you start to see those dollars roll in and, your client book expands and your ability to basically make certain demands in the marketplace, because when you think about it, I hate mortgage brokers, quite frankly. There's a difference between being a mortgage broker and going out to 10, 15 different lenders to get the same quote and the lender itself. Okay. They're an intermediary. They have even less risk or exposure than a lender does. And they're just there to make a fee. That's it. And they get paid by the borrower, the GP, and they also get paid by the lender. Okay. In yield spread or cash fee commitment fees. So they're really getting two bites of the apple from different sides for serving really no purpose other than trying to beat lenders up that are offering the same product for the sake of 5 or 6 or 7 extra basis points, because the results and the terms and the structure come from the top down, meaning the agency themselves, and those don't change. Right. So if a mortgage broker is out there and they send it to 4 or 5 different seller servicers on a Fannie or Freddie Mac product, the terms are going to be the same. It's just about, okay, how do we wedge our fee into the spread? Where can we make more? Who's willing to give up more? And that's probably the outcome we're going to go with. It's a commodity business, right? And so I think that moment in time has been flushed out a bit. I think it's been good for the business. There are good mortgage brokers out there. And what I mean by that is that, if you're acquiring a property, you might want a bank quote, you might want a life insurance quote, you might want a quote from Fannie and Freddie. And so there is value to be had there and fees to be earned. But I think people got a little over their skis at that moment in time when nobody could do wrong in our business and greed took over. And they just wanted to get more and more deals done, keep that ball rolling down the hill in order to maximize profit.
Well, I appreciate your transparency and your willingness to talk about it. I can kind of speak to the cleanup that you mentioned. We financed the multifamily property we closed in May. While we were down there for due diligence, there was a representative from the lender that actually came into the leasing office. They weren't willing to accept documents that were furnished by us on the acquisition team. They actually wanted to be in the property management leasing office, in their software, and pulling data themselves from the software so they could validate rent rolls, lease expiration dates, financials, et cetera, et cetera. So to me, I thought that was kind of a nice thing if you're an LP to know that kind of stuff is going on, because it's an extra layer of due diligence that you would never have access to, but it's a protection for you sitting in the common equity position. So I think that's a good thing to clean up the industry a little bit. But let's get back to due diligence a little bit. Whether it's a situation like we were just talking about or the last few years, let's face it, have not been really strong in commercial real estate broadly, but multifamily has really struggled. Mostly deals that were done with floating rate bridge debt. And then, obviously rates took off and we know what happened from there. But is there anything in your eyes, kind of coming from your background, that you could have said to an LP, hey, this is what you should have done differently, looking back 3 years from now? Obviously, hindsight's 2020. I'm not asking you to say don't invest in bridge debt. That's a risk tolerance thing, but just from like an underwriting standpoint, from a overall due diligence standpoint as an LP, could any of this stuff been avoided, and how so, if so?
Yeah, I think it goes back to the point that I made earlier about knowing your GP, right? There's a lot of syndication out there. There's a lot of fund of funds, feeder funds. We're considered in that vein at Seaport. But, listen, there's good debt in the market. And some of that's high leverage. Some of that's expensive. It's just got to be commensurate with the outcome and the business plan. And, the operator behind that debt vehicle needs to know how to use it. They need to know how to steer it, what levers to pull, how quick they can get out of it, how quick they can execute that turnaround. And so I think, a note to LPs is just simply know your audience, right? Know your GP, know their track record, know their experience. One big thing for me is cycled deals. And not to say that there's not new GPs out in the marketplace that are doing good things, for the first time or the second time. Or maybe there's, a portfolio that they've acquired and they haven't exited anything over the last 3 to 4 years because no one's exited anything in the last 3 or 4 years. But that doesn't make them bad operators. I think transparency is crucial. I think, understanding and developing a relationship and a rapport with the individual that's calling the shots on the day-to-day and running the project is significant. That can far outweigh paying 7.5% for a bridge loan for a property that, you have to because it's 40, 50% occupied and there's no other execution out there for it. But that doesn't make it a bad deal so long as that the right person is steering that ship. And so I think, again, we try to, yes, we invest with our bench of operators that have been with us for 5 or 10 years. But your point, as it relates to the bench that we're expanding going forward, our last 4 deals that we've done, we did a 2-pack in Spartanburg, South Carolina, brand new GP operator. Next 3, we closed one in Savannah, new operator 2 weeks ago. Obviously, Indianapolis tomorrow, new operator in Gray Capital, new operator in Houston, right? But as a steward, I guess, of this capital or a representative, we have to do our homework on these people. We have to go fly to the property. We have to go meet these people face to face. That goes a long way, even if it's a day trip, even if it's a Zoom call, whatever. But you really got to understand who these guys are, how they run their day to day, what their ops side look like. I love self-managed folks, right? Generally, as I mentioned, that comes inherently with being local to the property. But I think understanding your GP, understanding your audience, and anybody can put those, return metrics on an OM that we mentioned earlier in the call. But okay, what does that mean? How do you get there, right? And really speak with these people, understand their business plan, their strategy, what they're going to do on site, the improvements. Where are rents today? Okay, if you're putting 5 or 10,000 a door in CapEx, where do those rents go tomorrow? What's the turnover? Ask simple questions, which, okay, if they can't come up with the answer, that there's some type of not misrepresentation, but ignorance or lack of knowledge in basic, kind of curriculum of multifamily operations. So audience, GP diligence, understand who they are, what they've done, what their goals are, for your capital, most importantly.
Simple and effective framework. I love it. Ryan, this has been a great conversation and fascinating. If people want to learn more about you and Seaport Capital, where can they find you?
We're all over LinkedIn. It's been a quick, call it 10 months, since I was able to market myself and brand the business since I left corporate officially in January. So yeah, we're all over LinkedIn. We'll be putting out kind of a mini podcast series in the next week called GP Spotlight, where I take 30 minutes and introduce the GPs that we've invested with over the last 12 months to the world or outside of their world. So that'll be coming up, and we'll do some marketing on that. We have our website, seaportequity.com. To the extent people want to do a bit of a deeper dive into the deals that we've closed or the funds that we've closed, we have a distribution list. We have a portal set up, which really gives folks kind of the who, the what, the why, and the where with the deal flow and the consistent pipeline that we have. Otherwise, reach out. We're talking to LPs all the time. We're trying to add value everywhere we can and grow and introduce the world to the access, which is pretty unique that we have.
I would say so. Well, this has been a great conversation again, Ryan. Thanks for joining us today on the Passive Pockets podcast.
Awesome. Appreciate you. Thank you.
Today, we heard how a lender sizes risks, which metrics actually drive loan terms and survival, and what LPs can do to avoid preventable mistakes. Ryan's perspective shows why capital structure, cash buffers, and honest reporting matter as much as the pro forma. If this helped you sharpen your due diligence checklist, subscribe and join the conversations at PassivePockets.com for more case studies, underwriting, deep dives, and sponsor reviews. Big thanks again to Ryan Duff for the insights, and thanks to you for listening. As always, happy investing.